Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's look at where we are on the year to date, not even a month into this, versus where we are on the session. Coming into Wednesday, the Nasdaq 100 down by more than 13%, the S&P 500 down a little more than 8.5, close to 9 percentage points lower. Your equity market this morning with a bounce. Futures up 1.5% on the S&P, on the Nasdaq up by more than 2 percentage points. That's the opening bell. Switch at the board and get to the bond market. Let's look at 10s and where we were in the middle of December. The last time the Fed met, December 15th, at the close that day, 145.65 on 10s. We've had a big move since then. From December 15th to the close at 145.65 to 177.44 right now. And year to date, over the last 3 weeks and a few days, up 26 basis points on the 10-year alone. This bond market has done a lot of work to start the year. In the FX market, the euro showing just a little bit of weakness again against a stronger dollar. Euro dollar down to 112.94, down almost 1/10% there. Look out, crude up another 0.9%. The rally's back on to 86.40, up about 80 cents on the day, up 0.9%. Around the open then is the rebound you were looking for. 45 seconds in, we're up 1.5% on the S&P. Information technology top of the pile, big move there, higher by 3%. At the bottom, underperforming. Consumer staples down 1/3%. Healthcare basically unchanged. Utilities basically unchanged. A ton of volatility, and BlackRock's Kate Moore says there's more to come.
Is it time to dive into the market wholesale? I don't think quite yet, John. I mean, I'm looking for the Fed to actually begin liftoff to sort of usher in an era of perhaps modestly less volatility than we've experienced in January. Like, our base case expectation is that Powell is going to sound a lot more dovish than some of the extremely hawkish economists who've been upping their forecasts over recent weeks and since the start of the year. But that may not be enough to completely calm the market.
Back with us, Matt Hornback, Kathy Jones, Robert Tipp. Robert, I want to come to you. It's something Lisa and I have talked about through this week. There's a difference between market functioning and market pricing. The Fed would be much more concerned, I think, at the moment at least, about the former and not the latter. Is there anything to be worried about when it comes to market functioning? Is anything about this disorderly?
I think so far things are reasonably good, and I'm sure Matt will have something to say on this as well. But I think the two go hand in hand. And what's not to be forgotten is that over the last 12 months, it's been a very buoyant retail flow environment. You had better part of $1 trillion going into both equity and bond mutual funds. And you had all the world's central banks doing their part, injecting liquidity into the system. And you had new facilities to offer financing or to park your money overnight. So it has been an incredibly facilitated backdrop. And now we're looking at an environment where the central banks are really scaling back those purchases, and the markets are becoming more volatile. You're kind of seeing a setup. I mean, we've seen a tremendous volatility in January, so hopefully we're not going to see this kind of level of volatility throughout the year. That would basically be like 2018. So if you get that environment and you get the market volatility, you will begin to lose market function. You will see illiquidity come back into the system. Now, will you have where the kinks in the market are going to pop up this time? Last time it was repo. I'm not sure, but illiquidity at any rate and market volatility tend to go hand in hand these days, and I think that's what the Fed is going to have to guard against. That's what's going to be the canary in the coal mine for them as they go through this withdrawal and stimulus process.
Matt Hornback, your take on this?
Yeah, I completely agree with Robert. I think when we look at the relative value opportunities that you see on the Treasury curve, typically when market function breaks down, you see a lot more relative value opportunities show up along the Treasury term structure. You're seeing a little bit more today than you did at the height of the liquidity provision over the past 18 to 24 months. But John, the relative value opportunity set is still less than it was during the entirety of the last hiking cycle. So I don't think the Fed can look at what's happening in the Treasury market today and think that something is broken or they're getting even close to the period of time where something might break. We're still trading in a very healthy environment. And John, let me just add that probably the biggest area of concern in the Treasury marketplace is with the TIPS product. And if there was truly concern about liquidity in the TIPS market, then I doubt the U.S. Treasury would be asking primary dealers whether they should issue even more TIPS to the marketplace. So I think we're quite a ways away from anything breaking down in the Treasury market, John.
Kathy Jones, your thoughts?
Yeah, I would agree. There's no indication right now from what we can see that there's a liquidity problem. Obviously, if the Fed were to move really, really fast, it could kick off a lot more problems in the market. But where we also kind of have to consider is they have a huge balance sheet to work with. So they have, lots of bills. They have the reverse repo facility. There's a lot of money for the Fed to deal with any pockets of illiquidity that come up. But so far, so good. I do think volatility picks up this year. I mean, that's sort of a function of slowly trying to drain liquidity, right? We've had very buoyant markets, particularly in the credit markets, as a result of all this excess liquidity. So, at some point, it's not surprising to see some volatility there. But I don't think that we're near, as Matt said, a breaking point where it's a function problem for the Fed.
5 minutes into this one, let's call it 6. We are higher on the S&P by more than 1%. On the NASDAQ, up by about 2%. The Microsoft story helping out there. The guidance is decent. We'll catch up with Ed Ludlow on that in just a moment. Microsoft up by a little more than 5%. After all the volatility, after the big downdraft, the drawdown year to date, many people lining up to say, let's buy the dip. Peter Oppenheimer at Goldman with a nuanced view on this. He said any further significant weakness at the index level should be seen as a buying opportunity. There is a but here. Look out for the growth risk. With more, here's Abby.
Well, John, it's an interesting question for sure because the sister to buy the dip is sell the rip. So until there's an all-time high, that may be the case. But today, the dip buyers do appear to be out. We have the S&P 500 up more than 1%, as you were mentioning, the best day of the year. And interestingly, over the last 2 days, it felt like the S&P 500 was in a correction because of the brutal volatility. But over the last 2 days, not so much. Right now, the S&P 500 down about 7% from its all-time high. So not in that official correction of down 10%. But the stock selling's not here in the U.S., just in the U.S. It's also on a global basis. The all-world index over the last year higher, but recently at an 8-month low. So a big, brutal sell-off there as investors worldwide wonder what central bank tightening could possibly mean. Of course, also fears around the global growth picture perhaps slowing. As for what is working, John Authers here at Bloomberg, he, not surprisingly, shows that it is all about value, buybacks, dividends. On the bottom, though, not surprisingly, folks are selling volatility, growth, momentum, and the highly shorted stocks. Let's see what happens after this Fed meeting. Anything seems possible, John.
Abby, thank you. Let's check in on Microsoft, up more than 5%. Joining us on the West Coast, Ed Ludlow. Ed, if you left this when the numbers first came out, you missed the story, didn't you?
Yeah, exactly. The market took a minute to make up its mind on Microsoft, John, because we got the strong top and bottom line beat. But going in to this week of all weeks, really, with the mega caps, Microsoft being the first, we knew that a beat on the top and bottom line wouldn't be enough. They wanted to see the outlook. And if we bring up the kind of key takeaways from Microsoft's earnings, that's exactly what we got. The outlook for the current quarter in terms of Azure sales growth will be rising significantly, and that really tipped the scales favorably for Microsoft because they did have strong growth. Coming into my Bloomberg terminal, this is the 18th quarter in a row where we've seen top line growth above 10%, 20% for the quarter, and even Azure itself grew sales by 46%. 46% growth is nothing to kind of dismiss, John, but it was seen as decelerating, and that was the concern. Let's frame this, right? It's Fed Day, John, and I think a hope from the bulls on the street, those following the technology sector, is that we'd have a reset. Microsoft was supposed to be the first mega cap. If we got the strong outlook, then even though it's Fed Day, we'd have a bullish tilt where we stop worrying about the outlook for higher rates and the impact that will have on technology stocks and just start thinking about the fundamentals. How strong are these businesses and what is their growth outlook for the rest of the year? But of course, each company has an individual narrative. We go to Apple on Thursday night. We go to Tesla tonight. All of these things have different supply chain, higher input cost headwinds. And this is what we want to see, that outlook for the year. We may get top line growth in the quarter just gone. There's some seasonality when it comes to Apple. Will that be good enough?
Ed Ludlow on the three big names to report this week. Ed, thank you. Ed mentioned those three names. So yesterday we had Microsoft, today Tesla. Tomorrow we'll hear from Apple. Those three names more than about a quarter of the NASDAQ 100. Microsoft makes up a little more than 10%. So think about that move in Microsoft as you look at the NASDAQ 100 this morning. Microsoft up by almost 5 percentage points and the NASDAQ doing nicely too off the back of it. A final word now from Matt Hornback, Robert Tipp and Kathy Jones. All three of you are across credit to some degree, some greater than others. And Robert Tipp, I want to start with you. I want to gauge where you think things are just in terms of corporate fundamentals, where leverage is, what the maturity profile looks like more broadly as we start to enter what looks like a big rate hiking cycle. What do we look like, Rob?
Yeah, I would say the corporate sector is in good shape. I mean, the upgrade to downgrade ratios are very strong, and we've had a very high issuance, buoyant market to reprofile maturities. There are virtually no defaults last year in high yield. So it's been a very strong credit environment, and I don't think the central banks are going to take enough of an edge off the economy here to really dampen them. And those underlying fundamentals are there for structured product as well, by and large. So very strong underlying fundamentals. Now, spreads have gotten incredibly tight, but I think what we're looking at is a range-bound market for spreads. It's going to be a bond picker's market. But on average, as we go through this, I think your long rates probably remain range-bound on the Treasury market. Your spreads remain relatively range-bound, and there's a lot of bottom-up opportunity. So I think a reasonably good environment for credit, and that usually, is the case on the credit side at this point in the cycle, and it's also often the case in these recent cycles. The long rates also peak early in the Fed cycle.
Matt Hornback.
John, yeah, we share the same view. I think, honestly, what we're more focused on is what's happening in the agency mortgage market in the U.S. The type of spread widening we've seen in agency mortgages, which of course is a security that the Fed holds a lot of these days, that to us is really the main focal point, especially when we think about credit and how investors might be allocating to credit vis-a-vis agency mortgages. Of course, looking at core plus portfolios, that's a big decision for managers to make. So the widening in agency mortgages is something we are going to be tracking very closely. And by the way, John, if you look at how agency mortgages have been performing alongside real interest rates in the U.S., the correlations have gone to 1 essentially. So we think that this is really the main focal point, given that we're facing the Fed decision today.
Kathy Jones, final word.
Yeah, I think the corporate fundamentals are very good for credit. We've seen a little bit of spread widening, but not very much. They're really hanging in there pretty well. I think if there's one thing that concerns us is that in every tightening cycle, you find out, where the weak spots are. And in high yield, one of the risks to us is simply that investors pull out, look at more attractive opportunities with less risk. And so, we're worried about the level of tightness in spreads in the high yield market vis-a-vis the tightening cycle. So that's where we'd be a little bit more cautious. But in general, credit looks pretty strong.
Kathy Jones, Robert Tipp, Matt Hornback on this Fed decision day. A busy one for us all. Thank you so much for giving us so much of your time. About 13 minutes into the session, the S&P 500 up a little more than 1%. On the NASDAQ, up by 1.73. Coming up on the geopolitics, the president rolling out American forces in Ukraine.
There is no intention or interest or desire by the president to send troops to Ukraine. NATO is a forum to support our eastern flank partners and countries, and that's what the focus has been on.
That's next. This is Bloomberg.
This is Bloomberg's The Open. I'm Ritika Gupta, live in the principal room. Coming up, Gina Raimondo, U.S. Secretary of Commerce. That conversation, 10 a.m. Eastern at 3 p.m. London. This is Bloomberg.
We have no intention of putting American forces or NATO forces in Ukraine. But as I said, there are going to be serious economic consequences if he moves.
President Biden considering sanctions on the Russian President Vladimir Putin should Russia invade Ukraine. The UK mulling tougher actions of its own, with Foreign Secretary Liz Truss telling Sky News the following: "We are not ruling anything out. We will be bringing forward new legislation to make our sanctions regime tougher so we are able to target more companies and individuals in Russia." In Washington, Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John. Well, when we look at the sanctions picture across the transatlantic, this is really the heart of some of the tensions we are seeing, and especially when we look at what's going on in Germany. According to Bloomberg documents, Germany is trying to have this carve-out if there was going to be a block on transactions of U.S. dollars for the Russian energy sector. And of course, we talked about this. This is because Germany is so reliant on Russia's cheap oil and gas and on energy imports in general. And Olaf Scholz really spoke to that this week. He said that these sanctions need to be prudent. No one should be under any illusion that these sanctions are also not going to hurt us. This is at the heart of the problem. How does the West inflict pain on the Kremlin at the same time not damaging their own economies? And then, Jonathan, a little bit of a bizarre move. We talked about it earlier. It's not just Germany. When you have Italian executives ignoring the calls from the Prime Minister, Mario Draghi, to not get on a conference call with President Putin to discuss investments in Russia, you can see the intertwined relationships between Europe and Russia when it comes to the business community.
Isn't this part of the goal, to expose some of the divisions in Europe? Isn't that music to the ears of Russian leadership, Anne-Marie?
It certainly is. This is what they want. This is what President Putin loves seeing. He wants to see a divided West. This is why he likely clapped when there was Brexit and obviously a withdrawal from Afghanistan, a divisive America, things like January 6th. These are, as you say, music to his ears. And now, as they are talking tough and say that they are in lockstep and in harmony when it comes to sanctions, what's actually playing out is the fact that he sees that it is not going to be as easy for Europe to come down incredibly harsh on the Kremlin when it comes to sanctions, because there are a number of countries who don't want to inflict the damage on their own economies. Yep. And this is really the question the West has to take into consideration. And we should note, Jonathan, that since the sanctions following the annexation of Crimea, the Russian business community, and I've spoken to a lot of these executives from St. Petersburg to Vladivostok, they have really started to insulate their economy to try to make it sanctions-proof.
AMH down in D.C. Anne-Marie, thank you. Crude right now just short of 90. 89.67 on Brent, up more than 1% on the day. On WTI, just short of 87 at 86.89, up 1.5%. Goldman's Jeff Currie had this to say. He expects geopolitical tensions to have little impact. Take a listen.
Our base case is no disruption. You know, it's very unlikely. If we think about the sanction-imposed disruption, I like to call it mutually assured destruction. It's not in the interest of any party to stop flows of energy through Ukraine or even into Western Europe.
Let's get to Bloomberg's Julian Lee. Julian, do you agree with everything Jeff Currie just had to say?
Yeah, I do. I mean, if you look at the geography, there's not likely to be any physical impact on flows from any incursion of Russian troops into Ukraine, should that happen. The pipelines that carry oil and gas into Europe, those that cross Ukraine, cross northwestern Ukraine. Any fighting is likely to be in the southeast, so there shouldn't be any sort of physical collateral damage. And as both Jeff Currie and Anne-Marie said, you know, for Europe, the imposition of sanctions that limit Russian exports of oil and gas to European consumers is going to come at a very high cost.
That lead paragraph from Alberto Nardelli in Bloomberg, that the German government has pushed for an exemption for the energy sector if there is a move to block Russian banks from clearing US dollar transactions. That's according to documents seen by Bloomberg. That got our attention, Julian, but it didn't surprise you, didn't surprise Anne-Marie, didn't surprise me, and I imagine it didn't surprise many people who have just heard it. Julian, what is surprising to me is how little we've seen an effort, a big effort, to actually build up some real energy infrastructure where we can pare back the dependence on Russian gas in Europe? Why haven't we seen a bigger effort in Germany, not just over the last few years, Julian, but you've been following this for decades? Why haven't we seen that?
Well, I think, actually things in Germany have been moving in the opposite direction. We've seen, if you like, a growing dependence on Russia. And that's largely because, up until very recently, Russia has been a reliable supplier of energy to Eastern Europe and increasingly to large parts of Western Europe. We're seeing domestic production within Europe going down. North Sea oil production is going down. Dutch gas production has gone down very sharply. The biggest, and North African supply has been going down as well. And that was one of our other big import sources. But the area that's been growing, that has been easily accessible to Europe, has been Russia. So we've seen new pipelines being built to carry gas directly into Germany. We've seen new export terminals for Russian oil being built on the Baltic coast, supplying more crude oil and refined products into Europe. And other projects just haven't had the same, either the same heft in terms of volumes. When you look at natural gas pipelines from the Caspian Sea, they exist, but that shifts a reliance on Russia to a reliance on Turkey, and that doesn't really suit many people in Europe.
Julian Lee, on a situation that is not changing. If you think it's a problem, and we're told repeatedly it is, it's surprising to see very little done about it. Up next, your trading diaries. We count you down to a Fed decision just hours away. From New York City, this is Bloomberg.
facebook.com/intro.
"26 minutes in, you've got a lift here. Does it stick?" We've seen a lot of these moves go into reverse in the second half of the session. That's going to be dictated by Chairman Powell, you'd imagine. Up 1.8% on the S&P, a little more than 2% on the Nasdaq. The bond market story going into the Fed looks like this. Yields on a 10-year right now at 179, just a bit higher, up 2 basis points. Up 2 on 2s as well, through 1% to 1.0372. That's the price action. Here's your trading diary. New home sales at the top of the hour. President Biden meeting with private sector CEOs at 1 p.m. Eastern. We get a Fed rate decision and Chairman Powell news conference at 2 p.m. US GDP and Apple earnings coming up tomorrow. And finally, the employment cost index rounding out the week on a Friday. From New York, I'll see you later for the Fed decision. This was the countdown to the open. This is Bloomberg.
oxygen plants, temporary plants, some have put up permanent plants. I think the capacity for oxygen and other, medicines and, supply chain has been augmented, enhanced. So from that standpoint, I think, there's been expansion in capacity, in infrastructure. We've all sort of seen how far we can stretch the envelope.
China is considered uninvestable, then chances are whatever risk you're thinking about bearing in China, you'll be better paid to take it.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, January 26th. Here are the top market stories we are following for you at this hour. Decision day, the Federal Reserve gets set to signal its first rate hike since 2018. March liftoff is baked in, but investors are looking for clues on the fate of the balance sheet. The cloud to the rescue. Microsoft shares swing from losses to gains on an optimistic growth outlook for its Azure cloud business. Tesla, the next tech titan to report after the bell today. And a rebound, for now, after 2 volatile days of trading and a drop to the lowest level since June of last year. The Nasdaq 100 is leading a bounce back for U.S. stocks. The question, will it stick? From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, just about 4 hours to go until we get that Fed decision. What is that going to mean for this equity market?
I think we're all going to keep a careful eye on what is happening, but I think in some ways the main event is happening right now, and that's the news that we get out of the Bank of Canada, which has decided to leave rates on hold, despite the fact that the Bank of Canada is saying that economic slack is now, quote, essentially absorbed. It's slightly lowered its GDP forecast to 4.6 in 2021, 4% in 2022, 3.5 in 2023. Inflation forecasts higher, sees 4.2% average in 2022. I think we're at circa 4.8 right now. So certainly a slowdown there. But the main headline is that we do not have a rate hike. The market had expected a rate hike. Economists had thought that we would see a story of what we got basically, which is a hold. But the Bank of Canada removing its exceptional forward guidance and basically saying slack has been absorbed, but we're going to keep the benchmark overnight rate at 25 bips. So let's talk about this a little bit, because in some ways this was going to be the second major G7 central bank to hike rates. And if they had, I think maybe that would have stolen a little bit of thunder from the Fed. Mike McKee joining us now, Bloomberg's international economics and policy correspondent, to give us his take on this. Mike, a surprise?
I don't think so. A majority of economists thought they might hold, but a significant minority were predicting a rate increase. I think they're kind of in the same situation as the Fed. They're trying to condition the markets for a rate move going forward. They do, in their monetary policy statement, raise their forecast for inflation. So they're acknowledging there is an issue out there. It maybe they don't want to get too far ahead of the Fed because, of course, the interest rate differential could hurt the loonie and their efforts to provide growth in Canada. So not a surprise, but I don't think it probably just means that it's coming soon.
And Guy, this, of course, Bank of Canada is coming on Federal Reserve Day, and that actually is our question of the day, whether the Fed is facing a big problem given the volatility in the equity market we have seen. But Ira, it really has been confined to the large part in the equity market, the volatility of the last week or so. Do you think the Fed has a problem here if the rates market is relatively calm?
Well, it's not so much that the rate market is calm. I think that the Fed's problem now is, do they think that they're behind the curve, and do they think that because of their actions that the market will price for significantly slower growth in 2023? And I think that repricing of risk assets is something that they're going to have to acknowledge today, that certainly Jay Powell in the press conference is going to have to acknowledge. I will say something about the Bank of Canada decision, because, even though economists thought that the Bank of Canada was going to wait this meeting, the market was pricing for about a 70% 50% chance of a hike today. So, so you've seen actually the loonie actually start to come off a little bit on the back of this decision. So the markets were kind of prepared. Now, the way that I read some of the headlines, and I haven't read the full report yet, obviously, it's rather lengthy, is that that the Bank of Canada might still move before the Federal Reserve because they have another meeting prior to the March 16th meeting by the Fed.
Ira, do you think, coming back to the question, do you think that the Bank of Canada in any way has reacted to the recent volatility we've seen in markets? It's not just been confined to the United States. This has been a global phenomenon. Or do you think there's something else at play here? Why did they decide not to go this time? Is the background of what we're seeing on our screens on a day-by-day basis going to be a factor?
I think it's just, hey, why don't we wait a month? We'll just prepare everyone. The language that you mentioned earlier, Guy, about them saying that basically the slack is essentially gone from the labor market. That's the kind of information I think they wanted to convey. So, to Mike's point, the economists weren't expecting it. So I think they were maybe looking at what the economists were thinking for this meeting as opposed to anything else. But we're still going to be priced for another hike. And I think the challenge that central banks are going to have is not so much when do we lift off, but it's what's the pace and then what ultimately is the terminal rate. So how high do interest rates get this cycle? And for most markets, they're not thinking that they're going to hike more than 6-ish times in the terms of the Bank of Canada and the Federal Reserve this time.
All right, Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence. Thank you so much for joining us. And of course, remember to tune in to Bloomberg's special coverage of the Fed Decides. That starts today at 1:30 p.m. New York time. And Guy, of course, it's a very interesting picture we're looking here as we look ahead to the Federal Reserve, but also for the outlook for fiscal policy here in the U.S.
So fiscal policy absolutely front and center in all of this as we think about what's going to happen with Build Back Better. We've got a meeting taking place with CEOs. They're going to be talking about that today. So that's a factor that we need to bear in mind when we think about what is going to be coming out of this administration. So let's talk more about that and figure out what is going to be happening here. We need to now go to Washington, D.C. We have the Commerce Secretary standing by. We welcome our TV and radio listeners. And we welcome, of course, Bloomberg's Joe Matthew, because we are joined now by Gina Raimondo. She is the U.S. Secretary of Commerce. Joe, take it away.
Thank you. Indeed, we are joined by the Secretary of Commerce, Gina Raimondo. Madam Secretary, thanks for being with us once again on Bloomberg. As we consider the chip shortage, it's somewhere we'd like to start at this moment in steps that the administration is taking to loosen this up. We've talked a lot about it. Before we get into the next phase of this, I'd like to just set the baseline with you for our conversation. The White House was out with a report yesterday showing that this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
Good morning. It's always good to be with you guys, and thank you for having me. I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. Yeah. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
It brings us to one of the big steps you're taking, a legislative solution, the Competition and Innovation Act. That's made its way through the Senate. There's the House version was released last night. It's a massive bill. A lot of us tried to get through some of the thousands of pages that are in there. But once this dropped from Speaker Pelosi's office, we heard real pushback from Republican leadership in the House. Representative Michael McCaul, the ranking member on Foreign Affairs, said Democrats decided to torpedo any chance for a bipartisan bill. Is he wrong?
I think that's an unfair characterization. Speaker Pelosi worked incredibly hard with her team, with the chairs in a bipartisan way to put together, as you say, a 2,000-plus page competition proposal. Let me say this. There is broad bipartisan agreement. A bill very similar to what came out in the House was passed at the end of last year in the Senate with 19 Republican votes and nearly every Democrat. So to my mind, this is very reminiscent of the bipartisan infrastructure plan, which the president signed last year. There is broad bipartisan agreement that we have a national security crisis on our hands if we don't increase the domestic production of chips. Right now, we make no leading edge, the most sophisticated chips in the United States of America. We purchase nearly all of them from Taiwan. Congress cannot, sit on their hands and refuse to take action on that. And I've talked to many Republicans, including McCall, as recently as last week, who assure me they fundamentally support the goal and vision of the bill. So what has to happen is pass the bill, let's get to conference, and let's hash it out. There will be disagreements. The one thing I will predict to you is that the bill, which is the president ultimately signs, will not look exactly like the bill that came, proposed last night. So, let's get together. The bones are bipartisan. Let's get to a conference. This is a good starting point. And let's solve the problems that right now Americans are facing.
Time being of the essence here, so let's try and get a timeline for when it will clear the bill, when it will clear the House. When do you think that's going to happen? When do you think we'll actually start to be able to take action? We obviously had the news over the last few days about the plant that Intel is going to be building in Ohio, but that's a long way off. Madam Secretary, how quickly can we resolve this problem in the United States?
Well, as you say, these things take time. I was in Ohio on Friday. Intel made a $20 billion investment in what will be the biggest semiconductor fab in the country, if not the world. But here's what they also said. They could go from $20 billion to $100 billion in the next handful of years in America if and when the CHIPS Act is passed. So we have no time to waste. We have no time to waste. We hope that the bill goes on the House floor next week. We hope for a swift passage, and then we get to conference. And we have to move quickly. I cannot emphasize it enough. The chips we need go into the most sophisticated military equipment. This is about our competition with China. This is about creating jobs. This is about fundamentally shoring up America's economic competitiveness and national security competitiveness.
Let's get into the national security aspect of this, Secretary, if we could for a moment. We hear a lot about that. We hear that line a lot. So what does it mean as we hear talk of war on the other side of the world, the standoff with Russia, Ukraine? What is the U.S. doing to stockpile enough chips to take care of our defense?
Of course, we do stockpiling. But again, you can only stockpile so much. We need to make this in America. And by the way, I've spoken with probably 50 members of Congress since January 1st. Democrats, Republicans, many Republicans, they agree. The only solution is to make more chips in America. Purchasing 60, 70% of the most sophisticated chips from Taiwan is a vulnerability that is obvious. It's staring us in the face. And the bills before Congress are the solution. So I understand Republicans don't like every aspect of what the Speaker put out last night. So then do your job. Solve these problems. Find compromise and get the bill to the President.
Madam Secretary, are we in danger of weaponizing the chips industry? Is that what is happening here? The Washington Post was talking last week about the fact that the administration is looking at the foreign direct production rule to use against Russia to restrict access to the chips industry, to the most sophisticated chips that are out there, even some of the less sophisticated chips. Is that what is happening here?
So I obviously am not in a position and will not comment specifically on specific tactics and strategies that we may use vis-a-vis Ukraine and Russia. But the President has been very clear that the United States, with our allies, is preparing a range of very severe economic measures to impose on Russia if it further invades Ukraine. And I will say, it's not weaponizing semiconductors, but the fact of the matter is semiconductors are a vital component of every piece of technology, including military equipment.
Madam Secretary, we will watch with interest. We'll watch certainly what is happening in the House and watch the progress of the chip bill as it works its way through. We look forward to seeing some results there. The U.S. Secretary of Commerce, Gina Raimondo, thank you very much indeed. Our great thanks as well to Bloomberg's Joe Matthew, and be sure to tune in to Joe's Sound On. That is on Bloomberg Radio weekdays at 5 p.m. in New York. Okay. Let's move on, get some reaction to what we've just heard and look ahead to the Fed and think about the implications of what we heard from the Bank of Canada as well. Jan Hatzius, Goldman Sachs Chief Economist, joining us now. Jan, can I just start actually and think a little bit about what is happening with the economy? We just talked to the Commerce Secretary about what is happening with the supply bottlenecks that we're seeing in the semiconductor sector. How much of a problem is that going to be as an ongoing issue that we need to think about in terms of the inflation narrative, the inflationary narrative that is currently working its way through the U.S. economy?
I do think it's still going to be a factor that is important for the price level as we go through 2022. There doesn't seem to be a quick solution, so I do expect that prices in a number of goods producing sectors, and especially ones that rely on semiconductors, are going to continue to be high. With that said, inflation is about the rate of change of prices, and so I think the goods producing sector is going to go from, up very sharply on a year-on-year basis to much more stable a year from now. The question around inflation is really more in terms of how much of an acceleration you get on the services side and how tight the labor market is and what that means for wages. So there are definitely some clear risks, upside risks to the expectation that inflation comes back down to something, 2.5% to 3%, which is basically the Fed's view. But I don't think it's as much about goods, and it's really more about services and the labor market.
Well, let's talk about how the U.S. consumer factors into this as well, Jan. I want to point to a tweet from Claudia Sahm, who is over at the Jane Family Institute, previous economist at the White House and at the Federal Reserve. And she says the Fed is not going to have to do as much as the markets think because Congress is doing its best to slam people. The child tax credit was putting $200 billion at an annual rate in the hands of parents in December, zero in January, also letting COVID run wild. And Jan, I know that the child tax credit and the lack of a fiscal impulse this year played into your downgrade in a forecast for U.S. growth. How do you square those two things where we're talking about potentially less consumption, consumers maybe having a little more price intolerance, and also a Federal Reserve that you think could hike at every meeting from March in theory?
Well, there are a lot of moving parts in the growth outlook, and I would certainly agree that fiscal policy is going to be a drag on growth in the short term, basically because the amount of support is being stepped down. No more tax rebates, no more extended unemployment benefits, and probably no more expanded child tax credit. So that is going to be a drag. On the other hand, there still is a significant amount of recovery that we can see from post-pandemic sort of normalization, especially in the service sector of the economy. And that's been on hold a little bit in the very near term because of Omicron, but we do think that that's still going to be a factor. So where we come out is that the economy is still going to grow somewhat above trend in 2022, and in an environment where many labor market indicators are quite close to full employment, the Fed's probably going to want to slow things down to more of a trend pace, and I think that's still going to require higher interest rates. So we have 4 hikes in 2022, which is consistent with market pricing. But the risks are potentially that they would have to do more. And we think, even on our baseline, that as you go into 2023-24, we'll see additional rate hikes.
You've got terminal rates at 2.5%, 2 3/4. How quickly do you think we get there? You talk about the 4 hikes this year. Presumably we'll have to have more next year because we'll only get to circa 1% this year. Is that going to be enough to get to the point that you're talking about? Where is neutral, do you think, Jan, in terms of where the Fed is likely to get to and kind of think about what is happening in the economy?
Yeah, neutral is always difficult to estimate, of course, and there are a number of estimates out there. The Fed's estimate is 2.5% in nominal terms, or 0.5% in real terms, and we have a similar estimate. So, I think there's a reasonable case that maybe you go a little bit beyond that if the labor market continues to improve and inflation is still somewhat above the longer-term 2% target, which is our expectation. But it's obviously going to depend on the data. There's not going to be a sort of preset plan to get to a particular level, nor should there be. The Fed will need to respond to the incoming information on the economy and on financial conditions.
And when we look at that incoming information, is it going to be wages that is critically important, Jan? And do you think we are either on the precipice or already in a wage price spiral?
Well, I think wages are definitely an important issue for the inflation outlook, as we discussed. I think the question is, what do wages tell us about, where output and employment are relative to potential? We've seen some very rapid wage increases in the last couple of quarters on a sequential basis, quarter on quarter annualized. Our estimate is that that's between 5 and 6. That's been between 5 and 6%. But there are also, I think, some reasons to believe that maybe some of this is more temporary because of one-off retention bonuses and things like that. Until the end of the summer, you still have the expanded unemployment benefits, which we think had an impact on wage growth at the bottom end of the pay scale. So some of these things, I think, are going to be normalizing. We should see in our forecast somewhat slower sequential wage growth as we go through this year. But I think it's one of the key questions over the next 6 to 12 months.
Yeah, the phrase I hear the most at the moment is threading the needle. Everybody talks about the Fed threading the needle. Do you think the Fed is going to have to choose ultimately, and I think this is relevant to what you just said about wages, do you think the Fed is ultimately going to have to choose between tackling inflation and growth? And which side do you think they're going to come down on? Do you think they're going to be prepared to tolerate a little higher inflation just to maintain the growth level, to try and keep people employed and see wages going higher? Where do you think the balancing act lies? And do you think the Fed is going to be able to, now that Hackney phrased again, thread the needle?
I do think it's, threading the needle. I think that's a reasonable way to look at it. They have a dual mandate on both inflation and employment. And so they're going to want to put some weight on both. They would like to bring growth down to more of a trend pace and thereby, stabilize measures of labor market slack before you get clearly past full employment. And I think that's going to be the goal. I don't think we're necessarily so far away from that. I don't think we need a very aggressive tightening of policy to get to more of a trend growth pace, especially if financial conditions, continue to tighten. We've seen some tightening in financial conditions. Hasn't been very big so far, but I think that is ultimately probably necessary to see a slowdown to more of a sustainable growth pace.
Well, Jan, I'm glad you brought up the tightening of financial conditions, because our question of the day today is if the volatility we've seen in the stock market, the sell-off we have seen, creates a problem for the Fed. Do you think it makes their job easier or harder down the line?
I think it is what usually happens when you see a change in direction on monetary policy. I mean, a few weeks ago, I think you would have said it's been surprising how little impact we've seen on the equity market from the shift in the near-term monetary policy outlook. So now we've had obviously some very volatile days, and you wouldn't say that anymore. But I would still say that overall financial conditions, while tighter than they were 4 weeks ago, still haven't tightened, so much that the Fed would want to abandon the idea of a March rate hike, for example. We're not close to that, in my view.
Yeah, and can you just give me your thoughts on how we should think about hikes versus balance sheet runoff? And it's not one for one, and I don't know how you should think about it, but can you just explain your thinking around how you're trying to work out this problem, about what effect runoff is going to have, and how does that compare with rate hikes, and what the Fed is going to be thinking about around this issue?
So our expectation is that they are going to rely predominantly on rate hikes for normalizing financial conditions and the stance of policy, and the balance sheet runoff occurs in the background and is much less responsive to new information about the inflation outlook or the growth outlook. So it's not quite autopilot, because of course if there are large changes, then the balance sheet policy could be revised as well, but we don't think that's nearly as activist. We also think, based on our estimates of the translation of balance sheet size or asset holdings into financial conditions, we don't think there's going to be a very large impact from the balance sheet adjustment. Most of the impact on financial conditions, based on our estimates and the academic literature that has looked at QE and its impacts, really says that it's more interest rates and the policy rate and the funds rate.
Jan, we only have about a minute left, but market pricing already has come quite far in terms of expectations for future Fed policy. What do you think would be the biggest hawkish surprise that the Fed could deliver today?
Yeah, I wouldn't expect necessarily large hawkish surprises here. I mean, in theory, they could say we're stopping QE right here. That's something that has been talked about. They're still currently signaling to go and end only in March. They could do that, but we don't expect them to do that, just based on what we've heard from FOMC members. Chair Powell in his confirmation hearings, for example, was asked about the QE program, and he said it would end in March. So it would be a surprise, but I would not expect that. I think, otherwise the tone of how they talk about the inflation outlook, obviously it's going to be important, and there's always going to be something for the hawks and the doves. But I wouldn't expect a very disruptive type of communication. They're trying to get ready for the normalization.
All right. Jan, unfortunately, we have to leave it there, but thank you so much for your valuable insight on this Fed Day. Jan Hatzius, Goldman Sachs chief economist, appreciate your time. Of course, in addition to monetary policy, we are watching geopolitics, and the U.S. is now urging Americans in Ukraine to consider departing now. We are seeing stocks off of session highs, still up 1.8% on the NASDAQ. This is Bloomberg.
details about how bonds can be an important part of your portfolio. Henyon & Walsh has specialized in fixed income and growth solutions for 30 years and offers high-quality municipal bonds from across the country. They provide the potential for regular income, are federally tax-free, and have historically low risk. Call today to request your free bond guide. 1-800-279-5279. That's 1-800-279-5279.
We're about an hour into the U.S. trading session. Stocks are rallying, and Bloomberg's Abigail Doolittle is tracking the moves. Abigail, I got to be honest, I don't know if I trust a rally after the action we've seen over the last couple days. Is there a sign this one might stick?
Well, your point is well taken because there has been so much volatility. Who knows how we'll end up? But there may be some signs here that we could see these gains for stocks